podcast. I'm your host, Josh Appleman, founder and CEO of Appleman Capital. Today we're joined with Ruben Greth. Since 2019, Ruben has been scaling in heavy lift apartment projects and multifamily syndications. Ruben's launched the Capital Raiser Show podcast and manages various real estate projects across the U.S. Ruben, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Cool. My name is Ruben. I am a build-to-rent subdivision syndicator and a podcast host. I also do investor relations for something very similar to a debt fund with a company called YRefi. And I'm just out there in the world having fun. So glad to be here, man. Thanks for bringing me on, Josh.
Absolutely. Appreciate you coming on the show today. So tell us about when you first got started in real estate and what that looked like for the listeners.
Yeah, I got my start back in 2009 by going around town with a video camera and recording people at their real estate projects, whether that was either a fix and flip or primarily this one particular guy that was buying a fourplex every other couple of weeks. And I would just ask him, how did you find it? How did you negotiate the deal? Tell me what you're going to do to it. And then by posting these videos online on YouTube on my first interview-based thought leadership platform, we raised I should say my portion, I raised $625,000 in my first 9 months, and that's how it all started.
So you went around looking for people that were doing exactly what you wanted to do, and you posted it and told people how it's being done, and that gained a following.
Yeah, I should go back to that business model. It worked really well, actually.
I think that's the biggest people trying to connect the dots on how it's being done, and then what are the little nuggets of how to do it, and then what connects, what makes a successful transaction. That's I think that's the piece of getting started, and then what the blueprint looks like, and that led you into starting to invest and purchase your own real estate, correct?
Yeah, I am in real estate. I think the formula, at least with raising capital, is to educate, nurture, and expose yourself, or some people attract people to yourself. And some of the ways to do that is with thought leadership platforms, whether that's a meetup or going to conferences or writing a book, or in my case, doing a lot of YouTube videos. I think it's a fantastic formula.
And when you're doing videos, that enables you to learn more just by broadcasting what you've learned. So then it sticks. That's the education piece.
Yeah.
You're in a specialty portion of heavy lift apartments. Can you explain that to us?
Well, that basically, when I was doing that, it basically means going in there, removing all of the residents, gutting the property, and doing intense rehab, right? So we were doing that back in 2018 down in Tucson, and there's no cash flow in the beginning. So it's not a business for the weak-minded or faint of heart. You can find all kinds of crazy stuff, unhappy residents that when they leave, they would leave all kinds of stuff that you didn't want to find in places where you didn't want to find them, etc. So it was a fun business, lucrative business, but a challenging business for sure.
Yeah, you're changing the complete landscape of the property. So hopefully they're in a good area. That's usually how it turns out to be successful. Bad property as far as deferred maintenance, bad tenants, and then fix the property up, and then you change the property, but you don't need to change the area. It's already there. Is that about right?
Yeah, you're making an impact on the community. A lot of times removing riffraff from the removing everybody out there, but from the time that you find the property, I mean, you're removing all of the people that the neighbors don't want there. And then when you have the property ready to go, you fill it with people that are quality, that are going to make a little bit of an impact in terms of quality of neighbors to your part of town.
Got it. So you're doing the show, you're posting videos, and then you get into real estate investing. Did you go out and find partners that were doing what you wanted to do? What did that look like?
Well, it all started with the show, right? Because I was brought onto a group and they were interested in somebody that raised capital. And I was interested in how do I elevate from doing joint venture little fourplexes to how do I get into syndications and whatnot. So I saw a book, or I read a book by Joe Fairless called The Best Ever Apartment Syndication Book. And I went right to the chapter on raising capital. And it's like, you have to start a interview-based thought leadership platform. And I figured, okay, I think I've done that in the past with my YouTube channel. If I do that again with a podcast, how about if I do it on something called Raising Capital? And then through this process of becoming a podcast host, I met people and exposed myself to syndicators that were doing large apartment deals all over the country. And the people that I was working with just had little deals in Tucson. And I was like, well, I want access to all these deals across the country. And this looks pretty insane and fun and lucrative. And little did I know that it's pretty hard once you get out there and start raising capital for some of these lucrative deals. As lucrative as they may not specifically be in a market that's well known or be a business model that people easily understand. In my case, development, a lot of people that are coming from the multifamily space, I think it's a pretty easy business model to understand. You take care of the residents, you improve the property, you improve the efficiency, you get better property managers, you lower the expenses, and you increase the value of the property. Not too complex. You take care of the residents and they stay. Yeah. Now, when you start going into development, now you're talking about zoning, you're raising during multiple tranches during the, different phases of development, during the land, during the horizontal, during the vertical. You have lenders that are paying attention to building cost of cement and lumber and supply chain, and they're changing the lending parameters on you. You can do anything like, hey, we did a core sample on our piece of property and there was the bone in the core sample. So now there's an archaeological study. You're dealing with the mayor who might say, oh, I don't want Section 8 housing in my neighborhood. And you got to explain to them, we're not doing Section 8 housing, man. We're putting some beautiful houses over here, but they don't understand. And you would think that like a city official would, but they don't. They don't understand real estate as much as you would think. So it's very complex for the investor and for the developer. They're used to it, right? That's why they get paid well. That's why it's lucrative. But there's a lot of challenges that come along the way, and it's a more diverse, stronger, crazier risk profile, and that's why it's a little bit more lucrative.
Well, yeah, it's sometimes it's more lucrative because you have so much risk capital out there. I mean, you could have $1 million plus in risk capital just to find out that you can't even do the development.
That would be horrible. Yeah, you want some partners that can pick the right property and that are used to working with the city for sure.
Yeah, absolutely. And you could sit there and underwrite deal for deal for deal, and then it takes 2 to 3 years to finally get your entitlements, and then it's game on from there. But at the same time, you got a ton of time wrapped up in the process. So it needs to be more lucrative to offset the cost out there that you put on. And then, the city officials, as far as Section 8, have you done any of the LIHTC?
No, I have a good friend, Kent Leach, that does, I think, a little bit of that stuff. But that's not my party.
That's selling tax credits. It's a whole another different game to learn and specialize in. But there's a lot of nuances for sure, just like that. But tell us how you did transition over to development and what that looks like for you.
Yeah, so we were raising capital for different syndicators across the country, and there was starting to see an industry shift. People were moving because syndication was such a hot thing, for the last decade before COVID, that there was a lot of people just taking a class and all of a sudden they were syndicating and they were competing against the best of the best right in the same markets as you. And it was challenging to find a deal when there was like 20 people making an offer on the same property. So what we did to pivot, adapt, and evolve is get involved in a space where there was less competition, particular development. A lot of people ask us, well, why did you select Lafayette, Louisiana? And the reality is we had some really good friends that were amazing at building properties. They had built like 200 houses. They had a track record of finding pieces of land and working with the city. And we didn't know how to build houses, but we were good at raising capital. So they needed capital and we needed a project. We teamed up together and it worked out beautifully. That just happened to be that in their market in the southeast, land was very inexpensive and the cities were in pro growth, so that helped quite a bit. And they were phenomenal builders, doing A class and providing housing, new housing for the cities that wanted to grow. So it worked out phenomenally. But a lot of people don't understand development, as I was saying, and they don't understand Lafayette, Louisiana, which is a market that nobody has their cousin investing in. So it required an incredible amount of education and nurturing to get some of our first deals across the finish line, for sure.
What makes it a pro growth market? What does that look like for the listeners?
So
Because that's a path of progress, correct?
yeah, there's a couple of things, right? You want to look at net migration into the place where you're building. You want the cities to help you get through entitlements, and they might be incentivized to do so because they charge taxes and want to make more money as city officials. And one of the ways to do that is by providing more places where residents and people can live. So a pro growth market would be a place where land is typically inexpensive. There's net migration, positive migration, and the city officials are wanting to help you and not delay you. And a city like Phoenix might not really care how long it takes you for you to get your entitlements. So it's kind of an interesting dynamic when you go into different cities because the laws change so much depending on where you go. Build to rent and building houses is very different in Phoenix than it is in Portland, than it is in Atlanta or Florida versus where we are in Louisiana. And now I want to get back into it here in Phoenix, Arizona. So we'll see how that progresses over time.
Yeah, for sure. Tell us how the city can help. Is it tax abatements? Is it speed of the process?
Speed of the process, for sure. That's what you're looking for. How much trouble, how much time? Because it's a velocity of money game, right? If the city's telling you it's going to take you five years to get all of the things through, and your business model is to pay back the investors as fast as possible, you're not going to want to select a market that delays you. So some people are good at working with city officials or have those built relationships, and that helps quite a bit. But for a developer like me or somebody that raises capital, if I don't have the right people that are good at doing that, it can cause incredible delays for somebody like me moving into a new market, even if it's in my backyard, right?
Yeah, because just getting to the person you need to talk to can be weeks, and then it's their schedule versus your schedule, and he doesn't know you, so you're not a priority.
Yeah, and the whole time you're spending money on the interest that you're paying for the loan or whatever it is that you're doing.
Yeah. What economic drivers are you all seeing? Is it Amazon? Is it just industrial warehouses being built? What motivates you all to build a brand new complex in an area?
All of those things are definitely pluses. The appreciation, the ability to force appreciation are some of the drivers. What companies are moving in? Like you said, what kind of jobs are in place? Those are some factors as well. I think those probably it. I think the business model itself, like in our case, we're doing build to rent, right? So you have people that live in apartments that don't want a neighbor above them, below them, to the left of them, to the right of them, and no backyard, no patio, no driveway, no ability to have the dog get in and out on their own. And people are trying to squeeze, two people, some kids, possibly a parent, and a couple of dogs, and it's hard to do that in an apartment. So I think a lot of people really, if they can't afford to buy a house because nobody's selling a house because the interest rates are great, and nobody's buying a house because they're waiting for the rates to come down, if they're looking for a house to live in, build to rent provides some of that, solves some of that housing mess that's going on in crisis where nobody has a place to live right now. So if you can do that in a specific market, that's kind of some of the things that we're looking for.
Are you all buy and hold, or are you selling off to
hedge
funds? Yeah.
Our business model is kind of interesting, right? Because We actually operate it and look at it like it's one multifamily commercial property, right? So we build out the subdivision, we build them 10% at a time. In our case, like on a 100 unit that we're building right now, we build 10 houses and then start another 10 in a month later. And as we're building them, we're renting them out. And at the end of it, we have the entire subdivision rented out and we sell the entire thing as one commercial real estate asset to an institution or a syndicator that purchases the brand new, low maintenance, cash flowing portfolio. Where I think a lot of people that like houses, they don't want scattered site, right? They want all of their properties as close together as possible. And in a subdivision, they're all right there with one property manager and one leasing agent. So that becomes a situation where you can appraise it the same way that you would a multifamily property, as if it is all one property, and base it off of the net operating income of the entire subdivision of houses. So you can sell it off as one project instead of one at a time. Because I mean, if you're building 200 houses, you can sell them individually, but that's a lot of escrow processes and buyers, and it could be brain damage for you if you're selling that bulk of houses simultaneously.
Yeah.
So our model is let's just sell the whole thing to one individual,
Are
but you
you all
have
s-
multiple exit strategies.
are you separately deeding these as lots as you go, or is it one big plot of land?
In most cases, we are subdividing it and plotting them individually. Like in some cases, you might have a duplex or something like that, but for the most part, we're subdividing each plot into individual houses.
Got it. I guess that's the way the bank wants it done as well, just so that they can lean as they go or as they're built.
So I don't. Well, the bank has nothing to do with it, but for somebody that would eventually be a end buyer, it's easier to get financing for something that's 1 to 4 units because that's considered residential financing.
Got it. Interesting. So there's even a strategy on that end, and then you would
Mhm.
just instead of one, well, you could do one big takeout or just individually. That's interesting. That's
Like,
good.
I mean,
What it,
there's unique financing product like umbrella loans. Like if you wanted to have 10 properties all under the same kind of financing product, you could do something like an umbrella loan, but that's a whole different conversation.
Yeah, yeah, it's interesting how it all is how the capital stack is structured on the debt portion. And tell us about how you have to raise cash when you're going through development, because there's different tranches, and then you're
Yeah.
cashing out as you're raising new funds.
Yeah. So our business model is typically we take down the land with an option to purchase. We'll go up to a seller of a property or somebody that's got a piece of land and say, hey, we'd like to purchase this on the condition that we're able to change zoning. So we'll give them a deposit anywhere from $25,000 to $100,000 and then lock up the property. And while we're doing entitlement changes and seeing if we can accomplish the things that we want to, if we get those things across the finish line, then we'll go back and complete and exercise the option to purchase and then at that point, it's our piece of land. At which point, if we're going to do horizontal development, we can either raise for that phase, which is riskier than other phases. I mean, the riskiest is the land, right? Because who knows if you can even get it entitled. So that's why we do it with an option. But the next part is to raise money for the horizontal, and you can do that through joint venture or sale for future equity agreements, what's called a safe agreement, or you can go ahead and syndicate it. And then maybe you can have different classes. So some people invest in just that phase or maybe throughout the whole thing, but they get paid better than if you were to syndicate it at stage 3, which is vertical development. So let's say you put all the entitlements in, you get the engineering complete, you put in sewage, you put in electric and utilities, and you get all of the all of the plots created, and then you start putting the slabs and you're ready to build vertically. At that point, you may want to syndicate. That's the least risky and the fastest part of development because everything's been approved at that point, and all you have to do is bring the builders in, and then boom, you just go vertical. And so that being that it's less risky has a easier profile to digest, risk profile to digest for the investors. And it's probably the least lucrative for the limited partners that come in, but also the safest. So you can raise in phase one, which is the acquisition of the land, phase two, which is horizontal development, and then phase three. So that's kind of what we're looking at. And then, of course, the lenders can try and change parameters. The kind of loans that we get along the way are typically referred to as construction loans, but they essentially are the same kind of interest rates as a bridge loan or a soft money loan, probably like in the 9 to 12% range.
Got it. Tell us about capital raising in 2024, what that looks like and what you're seeing on the horizon.
Yeah. So right now across the industry, everybody's slowed down. It's challenging. You see a lot of pivoting and adapting, and a lot of people not purchasing properties whatsoever. Investors are leaving real estate or holding back or getting into non-real estate. Hopefully they can find something that's non-stock or something that they don't understand, so they can avoid the roller coaster. I mean, if you don't know or understand Bitcoin, and you don't want the roller coaster of the stock market, and you don't want the risk profile of real estate, and gold may seem safe, but a CD is not risky enough because it's only 5% interest rate that they're returning. So what do? You got to find something, right? So a lot of people have moved into debt right now. Fix and flip debt or a debt fund is very popular, very hot. The company that we're with, we are uh, student loan refinancers, and that's a pretty fun business because we have this portfolio of $65 million worth of loans, and we do like a Reg D 506C promissory note offering where we just do a fixed rate to the investor. You see very similar structures with debt funds across the country, and people like that, right? Because it's not a guaranteed, but you get a fixed rate for sure, and it's better than what you could get in the stock market for a lot of people, or what you could get with a bank. So in addition to pivoting, adapting, evolving, moving into either heavy lift or A class, or some people are getting into assisted living or unique niches, boutique kind of properties, or even like us, we got into development, right? Built to rent subdivision development. Other people are leaving altogether. They're getting into self-storage or RV parks or car washes or other lucrative things. But it's really tough to find a deal that pencils in value add multifamily. So what a lot of other people are doing is they're building systems right now. They're getting scrappier, and they're putting together either educational programs or AI softwares or CRMs or asset management softwares, and they're selling these things to stay alive, because if they're not doing deals and not participating in acquisition fees, well, how are they going to make money while nobody's doing deals? And these are some of the industry trends that I'm seeing. They're pivoting, adapting, moving into new sub niches, and or they're creating real estate programs, educational programs, coaching programs, or software businesses to stay afloat right now.
Yeah, yeah, and that's where I think it's going to be the year of the operator here with until at least 20. I didn't survive until 2027, but I say the year of the operator because operators can purchase at a different basis if they're owner operating the property and execute in a different fashion than third party property management. Um, there's going to be there's just a realignment going on, which is it's good for some, bad for some, and who knows what the landscape's going to look like, because they're not raising rates as of yesterday. That's going to stay steady for a little bit longer. But you got the 10-year approaching 5% as well. What is that? What are your thoughts on that?
I don't. So I stay in my lane, man. My lane is helping people get involved and exposing and nurturing and talking to people and building relationships. When it comes to the financing, I got partners that handle that because they're a lot smarter and they're more into the economy and what's going on there than I am.
Yeah, it's just it's different. It's got to reassess, realign, and in one fashion, it's real estate's on discount because you can buy at a different basis because the old pricing doesn't make sense, and a lot of people bought based on performa. So um, if you could give advice on raising capital in 2024, what would it be?
So start building systems, start educating, start figuring out how to story sell, share your story, share the vulnerable side of you, because people will connect with that. And then do a lot of conferences, meet a ton of people. I mean, the name of the game is networking and relationships. So the more people that you can get in front of and become friends with, maybe start a podcast or figure out some way to do an authority platform or write a book. Right now would be a great time to write a book if you're not crazy busy. A lot of my friends are still crazy busy, but that's kind of the key, I think, is if you can start getting in front of more people and figuring out some system, whether that's by hiring VAs or hiring a marketing agency or doing video content. If you can get out there to a bigger and stronger audience and build those relationships, that would be something I would highly recommend at this juncture in time.
Yeah, create your following and become a thought leader. And what about somebody that's looking to get into real estate? Your journey was creating content and getting in there. What if you could give yourself advice? What would it be to someone else who's looking to get in real estate?
Pick your partners incredibly wisely, because with real estate, what I found is that you can find somebody that's honest, that's a Christian or a spiritual person that has a focus on taking care of the residents, and they can still lose your money. And it's maybe not even because they're not good operators, but there's so many variables and interests or variables in real estate. For example, like a kid can come in and vandalize your property. And if you don't have the right insurance and don't have the right systems, like there's variables. You're dealing with toilets, tenants, termites. You got contractors that can run off with your money. So you want somebody that's got an incredible amount of experience, and you probably don't want to pick somebody that's at the same level as you. Like pick somebody that's like able to mentor you and walk you through the process. Be very selective and see if you can find some of their investors and find out what their experience is. One thing that I vet sponsors by, and I don't hear a lot of people using this particular aspect, is like, can you find out what the investor retention rate is? If you can find somebody that retains 70% of their investors, you better know that you should know, better said, that they are providing an incredible experience. A lot of people are very happy with 50% retention. When you start going into the 70s and 80s, you probably have somebody that's incredibly good at investor communications and investor experience and that kind of infrastructure. So you want to look for that. And then pick somebody that's like probably, you may feel uncomfortable and you don't know how to add value, but pick somebody that's bigger than you think that you're even capable of partnering with. Like for me, I'm in that boat right now where I'm trying to partner with family offices that are like $billion companies. And I'm just like, what business do I have working with them? Right. But it's the same thing. You have to pick somebody that makes you uncomfortable, but is a great operator with a great experience. Because those guys at the family office club, they want to see a lot of gray hair, and if I don't have it, they want to see a 25 to 40-year track record, and I don't have it. So how do you partner with them? You associate yourself with people that can provide them things that they're looking for. So that's my biggest key to success when it comes to getting into the game. Pick your partners wisely, and then, continue to do things to establish systems for raising capital.
That's awesome advice. The wrong partner can certainly set you back years and essentially be a leech if they're the wrong partner. You might bring more to the table and didn't know it until you partnered up with them.
Yeah,
That's
not
awesome.
to mention if you get investigated by the SEC because they're unhappy investors and they find out that you did something wrong, it's probably not that you're going to go to jail, but they may take your ability to capital raise away, and you may, spend all this time learning this business and filing for exemptions and figuring out the whole process, and then just to find out that, like, because you have some unhappy investors and people did something wrong, you no longer have the ability to capital raise for the next 10 years, and that would just suck.
Yeah, just
So
by
careful.
association. Yeah, no, that's great advice. That's huge. Very good. Ruben, we certainly appreciate you coming on the show today. If somebody wants to reach out, learn more about you, possibly invest with you, how can they reach out to you?
So they can find me on LinkedIn. They can reach out to me at the Capital Raiser Show. We got a website, capitalraisershow.com. Those would probably be the best places right now.
Yeah, I would highly recommend your podcast. You've got a bunch of great guests on there, a bunch of nuggets you can take away from one episode, and just level up your personal personal knowledge, and that way you can get out there and do it, talk the language. So
Yeah,
look forward to
Josh,
following you.
can I do a quick promo, like invite people to my conference that I'm doing for people that want to learn
Yeah,
the capital raising
please.
space?
Well, yeah, plug it in.
Go check out strategiccapitalraise.com. It's a 2-day event. It's advanced capital raising strategies. We have some of the best syndicators on the planet. They're going to be there, 50 plus speakers, 1,000 registrants, strategiccapitalraise.com. It'll be worth your time, I promise.
Awesome, Ruben. Definitely appreciate your time. I look forward to following you, and we will talk soon.
Peace and strength, my friend. Thank you so much.